So friends and colleagues, good afternoon, and welcome to this webinar on financing, investment, and firm performance in the Indian manufacturing sector. And there is an interesting paper which has been prepared by Professor Manmohan Agarwal and Ms. Rumi Ajim, and that will be presented by Rumi. She is already on board. And we have three very eminent panelists to follow up on that presentation. And they include Professor Jitendra Mahakud of IIT Kharagpur, Dr. Dennis Rajakumar, who is Director of EPW Research Foundation. I'm sure everybody knows what it is. And my own colleague, Dr. Santosh Kumar Das, who has been working on industrial finance related matters. So with that, let me invite Rumi to make a presentation. And Rumi, if you could finish your presentation in about 25-30 minutes, that would leave sufficient time for our panelists, because I really want to give them time to speak. They are all very eminent, and I'm sure you will also benefit from their remarks. And so over to you.
Yes, thank you.
Yeah. Yes, go ahead, please.
Is my slide visible?
Yeah, it is visible. We go ahead.
Okay, thank you. Good afternoon. Our paper is on financing, investment, and firm performance in the Indian manufacturing. So, there has been a sharp decline in GDP growth and manufacturing output after the global financial crisis. And this decline is characterized by significant slowdown in investment growth, driven by lower capital formation in the private sector. So studies have shown that in the early 2000s, the high growth in Indian manufacturing sector was driven by private corporate investments raised by debt, which led the firms to be over leveraged. And after the global financial crisis, the external demand fell, and along with this, the high debt servicing payments has led to a steep decline in private capital investments. So the existing literature has sought to explain this investment slowdown mainly in terms of macroeconomic factors, such as increased policy uncertainty, higher real interest rates, low domestic and global demand, and changes in the exchange rate, etc. Now, although these macroeconomic factors are important in explaining the investment behavior, it does not fully explain the investments of firms. So we use the firm level micro data to
Yeah, please mute yourself if you are not speaking. Yes, go ahead, please.
Ma'am, please unmute yourself.
Okay, thank you. So in this paper, we use the firm level microdata to explore whether financial distress has caused the decline in private investments in the Indian manufacturing sector. And our sample consists of 804 manufacturing companies over the period of 15 years, 2005 to 2019. Firstly, we analyze the trends in the growth of fixed assets, profits, and the leverage of manufacturing firms. Then we hypothesize that these three key variables are interrelated and are endogenously determined. So the growth in fixed assets depend on the profits of firm and the ability of firms to borrow. Profits in turn depend on the assets and leverage of the firm, and debt equity ratio or the leverage of the firm depends on the ability of the firm to service their debt, which in turn depends on fixed assets, and profits. So we hypothesize that these three variables are endogenously determined. And then we use a dynamic panel model to estimate our regression. Lastly, we present our results and conclude. Our main findings are: 1. We do not find substantial support for the hypothesis that financial distress explains the investment slowdown in our selected sample. Second, manufacturing firms, particularly the large cap firms, are practicing debt conservatism, which is in accordance with the pecking order theory. And lastly, we find that decline in sales growth of firms is a major determinant of the declining investments and profits of all the firms. And for small seminal paper by Modigliani and Miller, um, talks introduced the capital structure irrelevance theory, which states that capital structure is irrelevant in determining the firm's value. But this theory is based on unrealistic assumptions of perfect capital markets with no financial frictions. So when tax is introduced in this model, um, a levered firm has more value than an unlevered firm because of the tax shield benefit of debt. However, there is also cost of financial distress or bankruptcy associated with debt. So according to the trade-off theory, firms balance their tax shield benefit of debt and financial distress cost of debt, and um, they set a target debt level at the optimal level of debt, which is determined by the where at the point where marginal benefit is equals to the marginal cost. However, empirical studies have shown that firms have practiced debt conservatism. They forego the tax advantage of debt, and they deviate from the target debt level as predicted by the trade-off theory. So another development in the capital structure theories was pecking order theory. According to this theory, firms prefer internal funds to external funds, and within external funds, they prefer debt over equity. The first is preference of external funds over debt. So in the presence of information asymmetry about the actual valuation of firms, um, there is adverse selection problem in the case of debt. However, this problem is not present in internal funds, so firms prefer internal funds over debt. Another theory which supports the debt conservatism is the financial flexibility theory of Graham and Harvey, which states that firms deliberately choose lower debt ratios um, and forego the tax advantage to preserve their debt capacity in order to borrow in the future to take advantage of the potential growth opportunities. Second is the preference of debt over equity. This follows from the signaling theory of Ross, 1977. Um, if the firm issue debt, it provides a positive signal in the market that the firm is has sufficient cash flows to service their debt, and therefore their stock is undervalued. However, on the other hand, if the firm issues equity, it sends a negative signal in the market that the stock is overvalued. This preference also follows from the agency theory of Jensen and McLean. It is based on the principal agent problem between shareholders and managers in case of equity, and shareholders and creditors in case of debt. So use of debt increases firm's value as it reduces the agency cost um, because it forces the agent to make regular interest payments. Now, according to the Modigliani and Miller capital irrelevance theory, uh, there is no effect of capital structure on investment and profits. According to a trade-off theory, there is a negative relation between leverage and investment. And according to pecking order theory, there is a negative relation between leverage and profits. Coming to the empirical literature, most of the empirical literature have found evidence consistent with the pecking order theory. In the case of developed countries as well as the developing countries. And Frank and Goel, using data on American firms, found that the pecking order theory is more relevant in case of large firms. And as they included more and more small firms, the result got diluted. But in other case, Rao et al. Found that pecking order theory is also applicable to small and medium enterprises using data on India. Second, most of the studies have found a negative relation between firms, leverage, and investments. And some studies goes a step further, and they find that this negative relation is only significant for the low growth firms. A study by Shukla and Shaw for the Indian non-financial firms have found that firms leverage adversely affects its investment activity after a threshold of leverage. And for the relation between profits and investments, most of the studies have found that it is positively related. Now, in our study, the data is obtained from a profits database, and we categorize our firms into three categories: small cap, mid cap, and large cap based on market capitalization. And we exclude those firms. We select 300 firms from each category, and we exclude those firms where the values on key variables such as debt, equity, gross fixed assets, and profits are missing for more than 5 years during our sample period. Now, before moving to the results, we would like to discuss some of the stylized facts. One, the return on assets, which is a measure of profitability, has declined from 2005 to 2019 with a slight recovery in the later period. And this decline is the sharpest in small cap firms with the return on assets becoming negative for a brief period from 2015 to 2018. And this decline is consistent across most of the industries in the manufacturing sector. And the worst hit sectors are construction and real estate, consumer goods and FMCG, industrial equipments, and in the case of small cap firms, textiles as well. So particularly for the small cap firms, the return on assets have become negative in the subsequent time period. Now coming to the debt equity ratio, we again find that debt equity ratio has declined over our sample period, and this is consistent with the study of Chauhan 2017, where the author finds that there is a consistent deleveraging of Indian non-financial firms since the liberalization. And we can also note that the debt equity ratio is lowest for large cap firms and highest for the small cap firms. And again, this is consistent across the different industries in the manufacturing sector. Another stylized fact is the decline in debt equity ratio that we have witnessed in the previous slide. We will try to show that this is not because of the borrowing constraints faced by firms. This table shows the gross bank credit to industry, which is given in rupees billion. So we can clearly see that the data is available from 2007-8. So from this year, this has significantly increased over the period till 2019-20, and this is consistent across micro and small, medium and large enterprises. On the other side, for our selected sample of firms, we can see that the major proportion of borrowings are coming from bank borrowings. This is for large cap firms, and this has significantly this has increased over the period, and this is true for mid cap firms as well as the small cap firms. So both these facts indicates that the lower debt equity ratio or the decline in debt equity ratio is not cannot be entirely attributed to the borrowing constraints. Next, large firms have low debt equity ratio despite having high debt capacity. So we can see here this is the credit ratings of our selected manufacturing firms. We can see that for the large firms, this is for short-term instruments and this is for long-term instruments. For large cap firms, most of the firms fall in the category of highest safety or high safety. So, and we have also seen earlier that large cap firms had the lowest debt equity ratio. So in spite of having high credibility, the firms are having low debt equity ratio. This is consistent with the financial flexibility theory. And next, we also look at interest costs as a percentage of total cost of the firms. So we can note here that the percentage for large cap, mid cap, and small cap are low, and the increase in this ratio or this percentage is also low. So both these facts again indicate that the investment slowdown cannot be entirely attributed to the increased interest payments because of the debt overhang. Next, we look at the annual average growth rate of gross fixed assets and also compare it with the growth in shareholder funds and sales. So we can see that the gross fixed assets has decreased over the period, and the growth in gross fixed assets is lower than the growth of shareholders funds, which again reiterates that debt equity ratio is falling, and the growth in gross fixed assets is also lower than sales in the first two periods. So this indicates that despite having high capacity utilization, the investments of the firms still decline. And this is true for the mid-cap firms and as well as the small cap firms across industries. Now coming to our model, I is the index for firm, T is the index for year. We have hypothesized that these three variables, which is investment ratio, return on assets, and debt to equity ratio, are endogenously determined. So we have three equations here, and we estimate these three equations using the two-step GMM estimation and the dynamic panel model. So, and we also control for some firm level characteristics such as size, which is the natural log of sales, age of firms, growth, which is percentage growth in sales year on year, and market to book value, which is the market capitalization to total assets, cash flow, and we also control for year dummies. Here in the second equation, we also have non-debt tax shields, and in the third equation of return on assets, we also have liquidity and tax, corporate tax. Wait. Yes. So we have also done Houseman endogeneity test, which indicates that in the first equation of investment ratio and third equation of return on assets, all three variables are endogenous. In the second equation of debt equity ratio, we find that only leverage and profitability are endogenous. So this is our regression results. We see here that the debt equity ratio, here the dependent variable is investment ratio, and we have three categories: large cap, mid cap, and small cap. The first column in each category is for the fixed effects regression, where we have included the firm and year fixed effects. The second equation is estimated using GMM method without the dynamic effect, and the third column indicates the dynamic panel Arenalo bond model. So here we can see that the debt equity ratio, which is the proxy for leverage of the firm, is insignificant. The sign is negative, however, the coefficient is insignificant in explaining the investment ratio. The size of the firm, which is the sales, we can see here that larger firms in the category of small cap firms have a higher investment ratio. The younger firms have higher investment ratio in the case of large cap firms. And we see that the growth of sales year on year, this variable is significant in increasing the investment ratio, or we can say that the decline in growth of sales is significant in explaining the investment slowdown across all the firms. And cash flow is significant in the case of large cap firms. So all the other control variables have expected signs. Coming to the second regression, where we have dependent variable as debt equity ratio. Here we can see that again, the size of the firm is significant in increasing the debt equity ratio of small cap firms. And we can also see that the investment is insignificant in the case of large and small cap firms, but significant in increasing the debt equity ratio of mid cap firms. Lastly, coming to the third equation, return on assets is the dependent variable. Here we can see that similar to the first equation, the debt equity ratio is insignificant in explaining the profitability of all the firms, and size is again significant in the case of small cap firms. Larger firms have higher profits And we can see here again, the growth of sales is significant. The decline in sales growth is significant in explaining the explaining the decline in profits across all the firms. The liquidity is significant for mid cap in the first two columns, but not in the third column. And again, market to book value is significant for the large cap firms. The tax variable, tax rate is having expected sign in the small cap firms, and the coefficient is significant. However, surprisingly, in the large cap and mid cap firms, we found that the sign is not expected. It is positive and significant. Lastly, coming to the conclusion, we do not find any evidence in support of the hypothesis that financial distress has caused decline in investment of firms. We find that pecking order theory in the capital structure of particularly the large cap firms and decline in sales growth of firms is a major determinant of the declining investments and profits. And for small cap firms, the size of the firm is also important. Lastly, our findings of the paper suggest that measures to increase the demand can help in reviving the sales growth of firms and thereby private investments and profits of the firms. Thank you.
Thank you, Rumi, for giving a very clear and lucid presentation of the paper, which is a lot of rich analysis. And of course, you kept yourself to the time, and so which is very much appreciated. I'm sure our panelists will have a lot of their observations on this very rich analysis that you have conducted. So I would turn to them, and let me begin with inviting Professor Jitendra Mahakud of IIT Kharagpur. Professor Mahakud, you have the floor.
Yes, sir. Thank you. Rumi, am I audible?
Yes, sir.
Yes, and
Okay.
if you could kindly, sum up your remarks in 5 to 7 minutes, Professor Mahakud.
Sir, that's it. I only clarify
that.
the thing.
Yeah, good. Thank you.
Okay, you have attempted a particular topic which is relevant, but I have some observations. Maybe you can again work on this to make this paper more acceptable in that.
You are muted now. Oh, yes.
Yes. So one thing basically what I wanted to tell you that while going through your paper, what I find that your basic objective is to find out what is the relationship between the leverage, investment, and as well as the performance, right? Am I right? You can unmute. Okay.
Yes.
So what basically my suggestion is that there is no need to focus on the theories of the capital structure, right? Because
Yes.
the determinants of the capital structure or the various variables what we are trying to analyze to explain the leverage of a particular firm is well established, right? So the focus of the paper is basically we are trying to have a simultaneous relationship between the leverage, performance, and investment, right?
Yes.
So try to make the paper from the beginning on that. What focus should be only on that. It should not be on the basis of the theories of the capital structure, right? That is number one. You can briefly write something, but whole literature review, whatever you have given, that is on the basis of the determinants of the capital structure, what I find. So that basically is not required in this kind of paper. Number one. Number two, what I observed, that you have a very interesting results, but from the stylized facts, you have some very interesting results, but you have not given any justifications for that. For example, whenever you find your leverage is going down, right? Your growth is also going down, and as well as your return on asset is going down, and your investment is also going down. But why? You see, 2016-19, whatever period you have mentioned, in between there is a period, there is a crisis period. But interestingly, what you find that this kind of results you have realized in the period 2016 to 19. And that time, actually, the period was not very, we can say that unusual or abnormal period. This was a normal period, which was prevailed in the Indian market. So what could be the, as a researcher, you should try to find out that what could be the plausible reason behind that. That would add the value, right? Because if the leverage is going down, then as well as other things are going down, then that means there is something wrong somewhere else. So if leverage is not the reason, then what could be the reason? Maybe the probable reasons, right? So you try to make some kind of critical assessment of that particular findings. That is very much required. Okay, that is one basically observations what I find. And coming back to your methods, what basically you have adopted. If you look at, you have three equations, right? You have an investment equation, you have a leverage equation, and you have a performance equation. And what basically you have done, instead of using the 2SLS or 3SLS kind of methods, you have used the GMM, generalized method of movements, for analyzing this particular issue. But my point is that you see that whenever you are trying to establish a relationship between the leverage and investment, or leverage or a performance, you see investment is mostly determined by the cash flow. Have you gone through the investment literature?
Yes,
have
sir.
you read? So if
Yes,
you
sir.
see, there are various models like Wood's model, you have the Dobbins Q model, you have there are various models. That here, my suggestion would be, you see, whenever you have added leverage as a factor, and there are literature which tells that how leverage is affecting investment, right? But can you show some literature, or you have not highlighted any literature where it tells that investment is affecting the leverage? Okay, whenever you are assuming a simultaneous relationship between the investment and leverage, then we should establish that logic theoretically, right? This is number one. And number two, my suggestion is basically what it is, overall suggestion. Are you working on this particular topic as a PhD thesis or what?
No, sir, my PhD thesis is different.
Okay, this is a different work what you are doing. But what is basically my another observation is, if you want to have a kind of impact from this particular research, then this particular thing has to be established from the theoretical point of view, number one. Number two, it has to be tested from the different perspective. Different perspective in this sense, what I mean, if you go through the literature now, they are talking about how political uncertainty is affecting this relationship. You have divided only on the basis of the size, right? Mid cap, small cap, and large cap. But that is the exogenity, the exogenous factors have more role. If you go through the recent papers in Journal of Corporate Finance or Journal of Financial Economics, you'll find they're talking about the uncertainty, they're talking about the financial development, they're talking about the what we call it, the openness. Recently, I got a paper that FDI, how FDI is affecting this relationship, particularly investment. Basically, that paper is in Journal of Financial Economy, 2021 paper. Okay, so in that case, unless you bring from the different dimensions, different exogenous factors into the consideration, then general acceptability of the results will not be there, right? So that's why you have to think from the robustness point of view. You have to bring those things also into your analysis, right? And third thing is that whenever you have developed this particular kind of models, in that model, whenever you are estimating, use a particular technique. So that particular technique, you said that you have gone for the Houseman test and all these things for endogeneity testing. Okay, so you find that all are endogenous variable? All the three variables are endogenous?
In the first and third equation, which is the investment equation and the return on assets equation, we find that all three variables are endogenous. In the second equation, we find only two variables are endogenous.
Okay. So if there are two variables are endogenous, anyway, that I'm not, this takes a lot of time for going through this methodological part or technical part. But what suggestions basically I'm trying to give, this is basically on the basis of your issues, not on the basis of the methods, right? So methods can be anything, but you have to think of the why there is an endogenous relationship between the leverage and investment. What basically causes that? And already I told you about, you should think from the different other exogenous factors you have to consider to examine the robustness of these particular results, unless the acceptability will not be there. And another thing also, what I find from your paper, that you have not discussed any results. You simply have written something, some variable is significant, some variable is insignificant, right? But you have to explain that. Why? Whenever you are finding because it's empirical research, we have to always explain these particular reasons. What could be the implications of that particular findings? Unless you write that implications or that plausible reasons behind that, then it is not a value addition. Are you getting my point?
Yes.
So you explain that, why, what it supports which theory, or it is consistent with the previous findings, which findings basically supports that, which findings does not support that. So all kind of explanations and what is the mechanism or what is the implications of that particular, that has to be discussed very elaborately, right? It is basically, it is not, it should be policy oriented study, which basically some kind of results should be useful for investor or policymaker or manager, whoever it may be, right? And also, if you have the data, you bring corporate governance issues into that. That will add more value if you want to publish it in a better journal, right? Because the governance has a lot of impact on investment behavior, as well as the leverage behavior also. Even typical CEO's characteristics has a lot of, because at least I have done some of the studies on corporate governance and investment cash flow behavior. And what I found that CEO education has the impact, board characteristics has the impact. So there are a lot of significance, because the role of cash flow is going to be affected because of the governance patterns. So you try to bring those things into that. It will look, you have developed a nice problem, but that problem has to be formulated in a different way and bring the other exogeneity into that, and also try to explain the reasons why these things are happening and all. That will be it will come out a good paper in that case. Hope it will help you to enhance that particular result and your paper also.
Yes, thank you for your comments, sir.
Okay, sir, I'm done. Thank you.
Yeah, thank you, Professor Mahakur. As expected of you, you have given so much of a thought to this paper and brought out so many very important issues, which I'm sure Rumi and Manmohan will find to be of great help. I think your point about the corporate governance being one of the factors is very important, and this is something which I would like my other colleagues in the ISID to also take note of and bring in and factor in the relationships when they are testing. And also, I wonder whether this 2016 to 19 period where you find a dip, and as Professor Mahmood said that this was not immediately after a global financial crisis and what could be regions, whether you think this demonetization happening was a disruptor of some sort. But then you need to check whether that is a factor. But I mean, just a random thought which occurred to me, because 2016 was also the year of the demonetization, and it has affected some branches of industry, not all, but you can test that as well. With that, thank you very much, Professor Maku, for joining us and giving her the benefit of your insights, very deep insights, I would say. Now, let me turn to Dr. Dennis Rajakumar. He's also a professor in any case. Yes. So, and he's also an old hand on these issues of corporate finance and related matters. So I'm very happy that he's there. And so let me turn to Dennis. Over to you.
Thank you. Thank you, Dr. Nagesh. I must actually say that this is an interesting paper by Manmohan and Rumi,
Yes.
and particularly the context they have set in. That is all the more making the paper relevant. The context being why corporate investment has slowed down.
Yeah.
Right now, can this be related to certain factors which traditionally has been understood as the drivers of corporate investment, not only in India but drawing literature at the global level, right? Because bulk of their literature, when we carefully scrutinize, it is clear they have depended a lot on the experience of some of these countries like US and basically US studies, right? So drawing some inspiration from the traditional literature like capital structure, they try to explain why investment has slowed down, right, or has been slowed down for a while. So I see here that one underlying assumption while establishing the relationship is that relationship with any variable is that investment has slowed down. So I always see that assumption running throughout the paper, right? Whether that kind of a priori is good enough to, derive the factors responsible for it, one has to actually see it. Why I'm raising this point at the beginning itself is that I see a lot of value judgments following this in the paper. I'll come to that maybe after a few minutes. Now, there was a time, maybe a few years back, let us say some 6-7 years back, the idea of debt overhang was sweeping among the academics in the country, corporate debt overhang. And there was a time when economic survey also took cognizance of this situation, and they also cautioned whether economy was going through this kind of, the impact of corporate debt overhang or not. And that was a time when people were talking about house of debt. And what did they do? Some of the analytical firm, they picked up a few companies which had a huge amount of debt. And from there, they began to generalize that because of this kind of phenomena, the entire corporate sector in the country was going through a kind of phenomena that is normally described in the Western literature as a debt overhang, right? Now, when we, at some point, when we looked at this phenomena more carefully, then we noticed that that phenomena was not the case for corporate sector per se. Probably it was the case for a few companies which were highlighted in that kind of report. Now, what did we do? We looked at debt to equity ratio, and we found that debt to equity ratio from the mid 2000 did not go up any significantly. And I find that Rumi, though this sample is around 830 number of firms, but still her overall picture is that debt to equity did not go up during the last few years. I mean, almost 1.5 decades, particularly of large firms. And I'm sure that if you look at the proportion of large firms in the total sales of your sample firms, I'm sure they must be having a sizable portion. So therefore, for this kind of firms, debt equity did not go up, and therefore this would actually reflect on the aggregate level also, and you find that debt equity ratio did not go up. Then obviously there was another question. Then what explains this kind of declining corporate investment? Then people looked at profitability, whether it can explain this. There again, we noticed that profitability had declined. It provided some explanation. Then came an allied question. That is, what explains the decline in profitability? And this is the place where I find some of the findings reported in the paper becomes very important. Now, the paper that we are discussing now is somehow situated in the traditional literature of corporate investment, which is being we have seen it, right, except the recent development. Otherwise you will find that it is normally under situated in the context of accelerator principle, right, where they take a lagged output as an explanatory variable for the corporate investment behavior, or profitability. They see that profitability being an underlying factor for driving corporate investment. And subsequent to the developments in the literature on imperfections in capital market, we find that flow of funds, right? To start with the work of Azari and Verito, you will find flow of funds kind of literature also is being talked of. So we find that there is an interconnectedness in the topic, right? That is financing, investment, and performance. But like what the previous discussion was talking about, right? How each of them react on other, that is something that that cannot be explained by your capital structure theory per se, right? You need to go beyond that, right? Now, having said that, right, now let us look at some of the findings that you have reported. One is that you have looked at this investment behavior from the point of, as I said, accelerator principle, and you have also added profit as a component, and also you have added flow of funds. So that means you are trying to take care of all the three in one equation, right? Now, the question is whether there is kind of interaction among these three explanatory variables, right? Like for instance, we talk about financing, right? Now for financing, what is the indicator you are taken? Debt to equity ratio, right? Then profitability, right? You are taken profitability as an explanatory variable. Then you are taken sales also, right? Now, right? Yes or no?
Sir, investment ratio.
Yeah. So that also is an explanatory factor for profitability, right? Yeah. So here, what is very important for us is how do you connect all these, right? Now, whether capital structure theory is enough or not. Now, that is something please you try to explore, right, before you actually develop that, before you specify the model, right? Now, I have some comments on the description of your variables, right? Now, see the capital stock, whatever you have taken, right, that you are actually seeing that you have actually derived the market value, right, instead of going by the book value. And to derive the market value, you have used perpetual inventory method. Am I right? So you just see, since you have got some 830 sample forms, whether you should take perpetual inventory method, or there are some techniques available for capital stock estimation at the firm level, right? Probably if you do that way, then some of your the trend itself might change, right? Just be serious about it. What I'm saying is that, see, perpetual inventory method at some point, right, people did not favor it because you need a conversion factor at the beginning, right? Like for instance, you are talking about 2005 is your starting point. At that point of year, right, what is going to be your conversion factor, right? Are you going to assume that it's going to be same for small form, medium form, long, and the large form, and that too forms of different age, right? That somehow is you need to take care of that. Therefore, better you stick to some of the method used for firm level estimation of capital stock, right? That is one thing. Second one is, see, even though you have taken accelerator model, right, for your investment estimation, what I noticed is, see, you should always take the lagged value, because see, technically I invest, right, based on my expectation. So that means my investment in year T depends upon my performance in T minus 1. Correct? So wherever you need to use this, you need to do this take lag variable, please use that. I'm not seeing that is happening there. Right? That's second thing. The third thing is, see, in your total assets as well as in your, wherever you have used total assets, I'm not too sure whether you have taken book value of the total assets or whether you have taken the market value of the gross fixed assets in the place of book value of total assets. Accordingly, the trend might change, right? Now, many scholars do not do this exercise. Since you are already converted book value of the capital stock into market value, it is better you substitute it that way and see whether any change is there in the behavior. Now, very important point is, right, which is related to some of the equations you have used there, is that non-debt tax shields. See, by definition, what is the meaning of tax shields? I'm protecting my income, right? Now, either by means of adapting debt as my financing method or through means of non-debt method, right? That is through depreciation or through some other means. Now, how does it reflect in corporate balance sheet? It reflects in terms of the difference between the statutory corporate rate and your effective corporate rate, right? So merely taking depreciation to total assets will not serve the purpose. I'm sure that it is not a good way of describing it. Even then, if you want to take, in our country, it is known that depreciation being the major, tax incentive available to corporates. So even if you want to take depreciation, then the way is how much, because of the depreciation, how much of my income is being protected. So the ideal equation should be depreciation into tax rate. So whatever you get there, that you express it over total assets, that will give you some method of understanding how non-tax shields have actually played a role in your equation. Now, my last 2-3 points, with that I'll conclude. See, you have actually talked about you have compared debt equity ratio, and you are saying that large firms are debt conservative. This is what I said, that see, what is the criteria are you using to say large firms are debt conservative, right? Now, this is the place where you have to be very careful, because there are a lot of underlying assumptions in the paper, and based on that, you are making some value judgments. I would see this kind of statements as being part of your value judgments. Be careful. Unless you have solid criteria defined to say that, yes, beyond this level, I would say that it is conservative or not, then it's fine, right? Otherwise, while reading it, we are not seeing a very kind of, as if you are already predetermined what will be the results and you would like to actually fit in your findings there. However, having said this, your paper has a very significant finding, which we talked of even pre-liberalization period. I'm sure that it is actually raising concerns now also. That is, what is the conclusion of the paper? You are saying that the output plays an important role in stimulating corporate investment. That is nothing but accelerator principle, right? All that you have to do is you have to lag the variable and see whether it still plays an important role. But from the interpretation significance point of view, it carries an important message, right? That is, once upon a time, before liberalization, before 91, if you look at any studies on corporate investment, the common consensus at that time was, look, corporate investment in the country depends upon domestic investment, and domestic investment in the country depends upon public investment, and therefore there is a kind of one-to-one relationship between public investment and corporate investment. And in fact, some studies which examined profitability even before, in the 60s, 70s, and so on, they also looked at what determines the profitability. They concluded that it was investment, and then again, investment was linked to public investment, and public investment therefore played a key role. Now, my question to you is, you need to think aloud, because your conclusions are leading to the same direction of what the thinking we had at that time. This is the place with the points made by Jitendra is very important. Probably it's time that we have to re-examine the model you have used and include some of the exogenous factors, right, which would not have been traditionally discussed even in the Western context, but maybe specific to Indian context. Thank you.
Again, yes, thank you, Professor Rajakumar. Dennis, if I may say, thank you for adding another set of very insightful observations. And I'm sure they will be very helpful for the authors of this paper. In particular, I think exogenous factors brought in and explaining why certain things are looking like the way they are looking in the paper. I think is very important contribution, and your attention that you have drawn to the pre-liberalization literature, how public investment was considered as a very important explanatory variable at that time of anything relating to corporate sector. Whether that holds good now also, it is something worth checking. So with that, thank you very much indeed for joining us, and we will be in touch with you. I was thinking of connecting with you, and it so happened that we connected for this seminar, and now on we should remain in touch. Very nice that you joined. And now let me turn to our third panelist, my colleague, Santosh. Santosh, over to you.
Thank you so much, sir. I think there is not much to say, especially after the comments or the suggestions made by my co-panelists, Professor Mahakud and Dr. Rajkumar. I think they have covered most of the important, or you can say critical issues with respect to the paper. I have some observations and some suggestions. To begin with, some observation which Professor Mahakud has already mentioned, which is about bringing clarity with respect to the objective of the paper. Like if you look at the abstract and the introduction section and the conclusion section, so different languages has been used, and there is no definite objective per se. I think what Dr. Rajkumar has sort of indicated is basically the issue largely is about how do you explain corporate slowdown in corporate investment. And so that is something which can be the central sort of the question of this paper. So you can sort of work around that. Another observation is there are a lot of contradictions when it comes to the descriptive statistics, which is basically the stylized facts that you have mentioned, and also the statements that has been made in the introduction section. To name a few, like you have mentioned somewhere, investment slowdown is due to debt overhang, and in the stylized fact you say that the debt to equity ratio, then the leverage has gone down. And also somewhere you have mentioned about the twin balance sheet issue and all that. So there are a lot of contradictions, that you have is there in the introduction section, and the way it has been explained in the stylized fact. So that you can just take care of. The third issue is about the stylized fact section. I find it very interesting, but it requires further explanation, and it needs to be further discussed. So it's a few issues that came into my mind is like you have mentioned about immediately after financial crisis, the profitability of the large cap farms, it went up, and at the same time for the small caps it went down. So some explanation to that, for instance. And also you had mentioned somewhere in that stylized fact the which is also to me a sort of contradiction if I look at the whole paper, is basically we have said the profitability of the large caps have increased with increase in the interest cost. I think this requires some sort of explanation. So these are some of the observations that I must say, which you can perhaps elaborate a bit. About some suggestion, like in your regression sort of analysis, you may consider bringing in the issue of sort of including effective cost of borrowing. So this is very important when we are analyzing or sort of explaining investment of a firm. And already actually Dr. Professor Mahakur has explained, which is about the cash flow. Actually, in context of developing countries and many emerging sort of economies, will find, which your result also suggests, which is basically the farms tend to less rely on the external sources, more rely on the cash flow internal sources. So basically, to look into that and look into the sort of interlinkages between cash flow, leverage, and and profitability. And the important aspect from policy point of view is basically this area is lesser looked at, you can say. Is basically how this cash flow, phenomena of cash flow in many developing country, emerging market economies. So how it's going to impact or affect the operation of the monetary policy. So this is one of the major sort of aspect that to way forward, like in future you can consider working. So these are some of few suggestions that I can add of, other than what my co-panelists have added. Thank you so much.
Thank you, Santosh. Very helpful. I think I think between three panelists, Rumi and Manmohan, you have got very good insights how to improve this paper in terms of the problem and defining it, how to use the better methods and sharpen the results and explain them better. So with that, I think let me just see if there are any hands. Mohan Chutani wanted to say something. So Mohan, you have the floor.
Thank you, Nagesh.
Go ahead.
I must first of all congratulate the authors for good insight into the corporate investment behavior that they have tried to explain. And the technical issues, I think, have been dealt very well by the panelists. I'll not go into those issues, but 2 or 3 observations that I wish to make, which may help in supplementing the analysis and making it a bit more sharper. One is finally you conclude that financial, the investment decline is not explained by financial distress, but more by decline in sales and all that. But me, financial distress and decline in sales growth are a part and parcel of the same process. So they cannot be linked from each other. Secondly, I don't know, I joined a bit late. I was held up somewhere else also. Issue of capacity utilization is very important when you talk about investments. So whether full potential was being used, whether less than potential of capacity utilization was there, so analysis of capacity utilization in the times of financial distress is important to supplement your arguments and your conclusions that there are. I don't know whether it is there or not, but I think I missed that. So that's why I'm pointing out. And thirdly, during the period of 15, 16 to 19 or 20 or so, this period also in the international arena witnessed return of protectionism, return of nationalistic, especially the Trump era, the Trump presidency, and the related then aspects of international economic flows and other considerations. So that also, I think, directly as well as indirectly has affected sentiments apart from the domestic policies which you have captured in terms of taxes and various other things. And so these are few 3 areas where I think the analysis would become richer if you incorporate. But otherwise, I think that it's a very important paper. very timely, and if strengthened on the right lines, it will, will have important policy implications. Thank you.
Thank you, Mohan. I didn't introduce to those who do not know him. Dr. Mohan Chutani, currently with ISID, used to be an economic advisor in Ministry of Corporate Affairs. So he has a hand in in these matters, and as we can see, he has added some interesting insights. Now I see a hand being raised by Dr. Indrani Chakrabarti. So you have the floor.
Yes, thank you. Rumi, I have a question. Thank you for your interesting presentation. I have a question that in one of your tables, you have shown that growth of fixed assets was decreasing over time since 2005. And in the same table, you have shown also that growth of shareholders' funds was greater than the growth of fixed assets over time. So in other words, it was meaning that there was growth in the stock market. Stock market was growing, but it has no effect on investment. So what could be the possible reason for this kind of phenomenon?
Okay, so we'll ask Rumi to take up his question, but I want to check whether there is any other, member of the audience wants to raise anything with the authors. Any other hands? If none, then I want to ask Rumi to respond briefly to this specific question. And if you want to say anything about what our panelists have added, in terms of suggestions for your consideration. Over to you, Rumi.
I would like to thank the panelists. All the suggestions are very helpful, and I would definitely incorporate that in my analysis. And regarding the question that Professor Indrani has raised, that the increase in the growth in shareholders' funds is greater than the growth in gross fixed assets, which means that the stock market is rising. However, we do not see the same pattern in, we do not see its effect on the investments. I hope I have understood the question correctly. So one of the reasons, that the shareholders' funds growth is higher than the growth in gross fixed assets. However, it is declining over period. And one of the reasons that I can think of why this is there is because of the demand shortage. That this can be one of the reasons why the investments are lagging behind. I will look more into it regarding the reasons. I hope to some extent.
Thank you.
Okay, so if there are no other questions, and Rumi has already answered something on the Professor Chakrabarti's question, it is time for me to thank Rumi and Manmohan for this very interesting paper, as everyone agreed, and then to thank our three panelists, Professor Mahakud, Dennis Rajakumar, and my colleague Santosh, for adding their very detailed insights on all aspects of the paper, which I'm sure authors will find very helpful to refine it and sharpen it and make it a better, a stronger paper with some policy directions or guidance. So with that, I want to thank everyone who joined this seminar, and we will remain in touch with everyone about a continuous series of these research webinars besides the policy roundtables that ISID has started organizing. Thank you very much.
Thank you, sir.
Thank you.
Bye-bye.